Welcome to House Lux Estate, your one-stop channel for all things home and property related. We're all about empowering you with knowledge and tools to make informed decisions about your home. Whether you're a seasoned homeowner or just stepping onto the property ladder, House Lux Estate is committed to providing practical, easy-to-understand advice that makes sense for you. Today, we're tackling a topic that can feel a bit intimidating: catching up on your mortgage payments. We've all been there. Life happens, and suddenly, you find yourself behind on your payments. But don't worry, we're here to guide you through 5 effective ways to get back on track with your mortgage payments and regain control of your financial future. After all, your home is not just a property, it's a sanctuary, a place of comfort and memories. Without further ado, let's dive into our topic for today: 5 ways to catch up on your mortgage payments. First on our list is refinancing your mortgage. Now, you might be wondering, what exactly does that mean? Well, refinancing your mortgage is like hitting the restart button on your home loan. It means taking out a new loan to pay off your old one. But why would anyone want to do that, you ask? The answer lies in the interest rates. When interest rates drop, homeowners can refinance to take advantage of these lower rates. This means you'll end up with lower monthly payments, which can significantly reduce the financial strain and help you catch up on your mortgage payments. It's like a breath of fresh air when you're feeling the weight of your home loan. However, as with everything in life, it's not all roses. There are a few potential drawbacks to refinancing your mortgage that you need to be aware of. One of these is closing costs. Just like when you took out your original mortgage, refinancing also comes with closing costs that can be between 2 and 5% of your loan amount. Another potential drawback is the possible extension of your loan term. If you're a decade into a 30-year mortgage and you refinance into another 30-year loan, you're essentially extending the amount of time you'll be in debt. This means you'll pay more in interest over the life of the loan. So, while refinancing can be a great tool to lower your monthly payments and make your mortgage more manageable, it's not a decision to be taken lightly. You need to weigh the potential savings against the costs and implications of extending your loan term. Just like a tailor-made suit, the best solution for catching up on your mortgage payments is one that fits your individual circumstances. So before jumping into refinancing, take a moment to evaluate your situation. Consider your financial goals, the current interest rates, and how long you plan to stay in your home. Refinancing can be a lifesaver, but it's not for everyone. Evaluate your situation carefully before choosing this option. Next up, we have loan modification. This is another effective strategy that homeowners can use to catch up on their mortgage payments. But what exactly is a loan modification? Simply put, a loan modification is a change made to the terms of an existing loan by your lender. This change could involve a reduction in the interest rate, an extension of the length of the term of the loan, a different type of loan, or any combination of the 3. Now, you might be wondering, how does this lead to more manageable payments? Well, by reducing your interest rate, or by extending the term of your loan, your monthly payments become smaller. For instance, if you have a 15-year mortgage and it's modified to a 30-year mortgage, you'll have more time to pay off the loan, and your monthly payments will be significantly reduced. However, it's important to note that a loan modification isn't a one-size-fits-all solution. It requires a thorough assessment of your financial situation by your lender. The lender needs to be convinced that a modification is not only necessary, but also viable in the long run. So what are the requirements to qualify for a loan modification? The specific requirements can vary, but generally you need to demonstrate that you cannot make your current mortgage payments due to financial hardship. This could be because of a job loss, a medical emergency, or a significant increase in your living expenses. You also need to show that you can handle the new payment amount by providing information about your income and expenses. In addition, many lenders require that you're already behind on your mortgage payments before they consider a loan modification. However, this isn't always the case, so it's best to reach out to your lender if you're struggling with your payments. Loan modification, while not an easy process, can be a great way to make your mortgage payments more manageable. It's definitely an option worth considering if you're having trouble keeping up with your mortgage. Remember, the goal is to keep your home, and a loan modification might just be the lifeline you need. Third on our list is setting up a repayment plan with your lender. Now, this approach is particularly viable when you've fallen behind on your mortgage payments due to a temporary financial setback. So, how does a repayment plan work? Well, essentially, it involves you and your lender agreeing to a schedule that allows you to catch up on your mortgage payments over time. The beauty of a repayment plan is that it often results in lower payments, spread out over a longer period. This means you could potentially pay less each month, making it easier for you to manage your finances and gradually get back on track. It's important to remember, however, that while this approach can ease your short-term financial strain, you'll ultimately end up paying more over the life of your loan due to the extended time frame. Communication is key here. It's essential to maintain an open line of dialogue with your lender throughout this process. Be transparent about your financial situation, your ability to repay, and your commitment to catching up on your payments. Remember, lenders generally prefer to avoid foreclosure if at all possible. They're often willing to work with homeowners to find a solution that benefits both parties. So, if you're facing a temporary financial hiccup, don't panic. Instead, consider reaching out to your lender to discuss the possibility of a repayment plan. It's not a quick fix, but with patience and diligence, a repayment plan can be a viable option if you've just hit a temporary financial bump. Our fourth option might surprise you, renting out a part of your home. Yes, you heard it right. This might not have crossed your mind, but it's certainly an effective way to generate additional income to help with your mortgage payments. Let's say you have an extra room or a separate unit in your home that's not being used. By renting it out, you're effectively turning that idle space into a cash generator. The income you receive can then be dedicated to your mortgage payments, reducing the financial burden on your shoulders. But before you jump into it, there are a few things to consider. Becoming a landlord comes with its own set of responsibilities. You'll need to maintain the property, manage tenants, and handle any issues that arise. It's essential to understand the landlord-tenant laws in your area to avoid potential legal complications. Also, it's a good idea to do some market research to figure out how much rent you can reasonably charge. You'll want to ensure that the rental income covers a substantial portion of your mortgage payments, if not all of it. Lastly, consider the impact on your privacy and lifestyle. Having tenants means sharing your living space, so make sure you're comfortable with that idea. In conclusion, while renting out part of your home requires some effort and adjustment, it's a practical way to catch up on your mortgage payments. Renting out part of your home can turn your property into an income-producing asset. Our final option may be a tough decision, but sometimes necessary: selling your home and downsizing. This is a practical choice if your current home has become a financial burden or if you find it difficult to keep up with the mortgage payments. By selling your home, you can clear your mortgage debt in one fell swoop and possibly even walk away with some extra cash in your pocket. Once you've sold your home, you can then downsize to a less expensive property. This could be a smaller house, a condo, or even a rental property. The lower cost of your new home means lower mortgage payments or potentially no mortgage at all. This significantly reduces your ongoing costs, freeing up more of your income to use as you please. Selling and downsizing can be a hard choice, but it might be the best solution in certain circumstances. It's an option worth considering if your mortgage payments have become unmanageable. To recap, here are the 5 strategies we've discussed today to help you catch up on your mortgage payments. First, refinancing your mortgage can lower your monthly payments, making it easier to keep up. Second, loan modification can change the terms of your loan to make it more manageable. Third, a repayment plan can help you catch up on missed payments over time. Fourth, renting out part of your home could provide an additional income stream to help with mortgage payments. And lastly, selling your home and downsizing could free up a significant amount of equity, allowing you to catch up on payments or even pay off your mortgage in full. Each of these strategies comes with its own set of considerations, so it's important to weigh the pros and cons. Remember, it's important to consider all your options and consult with a financial advisor before making any decisions. Thank you for watching, and don't forget to subscribe to House Lux Estate for more helpful home and property tips.